Good evening, everybody, and welcome to the May 2013 edition of the Mid-Michigan Roundtable. I'm joined this evening by my friends Mark Robertson and Hugh McManus. My name is Ken Kabula. I'm the president of the Mid-Michigan chapter of Better Investing, and we're here to talk stocks this evening. I'm going to turn the session over to our fearless leader, the king of the roundtable, Mr. Mark Robertson. Mark, hello.
King, that's a lot of pressure. Well, greetings everybody and welcome back to the Roundtable. Again, this is our session that we've been doing now for going on 3 years, and we'll cover a little bit of that. Let's go ahead and dig right in. By the way, that picture on the far right has to do with the generic drug or generic pharmaceutical industry, and it's an image borrowed from IMS Health and some work that they've done. And Hugh is going to talk a little bit about Teva and generic drugs here as part of the session tonight. But we'll get the housekeeping out of the way first. Again, everybody here, I think we see a lot of welcome back to the familiar names. No investment recommendation is intended whatsoever. This is all about education. It's about demonstrating a philosophy and a method for basically discovering stocks, studying stocks, and owning them prudently. And if you're new to this, extra big welcome to you. We have a wonderful community of long-term investors who aren't afraid to dig in and learn. And again, everything we do here tonight is intended to demonstrate that method and share some of the techniques that goes on. This is just something I left in here, something we covered a few months ago. But again, it really is a matter of leaning on each other and iron sharpening iron. Investors making other investors better for the long term, and we really do believe that. Here's a quick look at the standing agenda that we try to follow virtually every month. We'll cover some opening salvos here and a little bit of a description of what we're doing. Talk a little bit about our results and where we've been. I don't know that we'll have a challenge, but we might kind of kick a little bit of that around, and then we'll have fewer selections than normal, so we'll actually have a little extra time probably for questions and answers on any of the stocks we cover, any stocks in the portfolio, or general topics that you guys might want to discuss. But you can see here that Ken is making a repeat selection of FOSL. It's a stock that has performed very well since he, I, and the audience selected it not so long ago. It's actually performed pretty well. And then I'm going to go ahead with, I can't believe I'm doing it, but a selection of Apple. And as it turns out, Apple's been selected twice for the portfolio, 1 year ago and 2 years ago. So we'll be tripling down on Apple here tonight. For Hugh's selection tonight, he's going to do something completely unorthodox and unprecedented, but we're pretty used to that from him. He can't find anything he likes, so he's going to pass. And then just go on to talk about Teva, which is one of the stocks in the roundtable tracking portfolio and the generic drug industry. And we will ask the audience to go ahead and vote. Here's a little background, especially if you're new to it. We basically do this towards the end of every month. We typically have 4 people selecting, if not 5. We will invite guests. We do have some guest knights and damsels. In fact, the guest knights have been very successful in the selections, and the damsels have done pretty good too. We do try to limit the non-core selections. That would basically be the stocks that really aren't so much up, straight, and parallel, and try to limit them in the portfolio, but we certainly welcome them in the spirit of exploration and discovery. Our goal is to, although we don't obsess on the portfolio, we'd really like to see the portfolio achieve outstanding performance over the long term and outperform the Wilshire 5000 by plus 5 percentage points. That's 500 basis points if you speak that language. So that's actually a pretty ambitious goal, and that matches the goal established by George Nicholson and the Modern Investment Club movement, and again, plus 5 percentage points versus the benchmark of the Wilshire 5000. While we're doing that, we do like to see the selections that we make basically beat the market 60 to 70% of the time. That's kind of an important number. What we're basically admitting there is basically 1 out of every 3 or 1 out of every 4 selections just might not work out quite so well. Slightly underperform, in some cases significantly underperform. And it's just important to realize that as investors, every once in a while it's just not going to go your way. You could be Superman or Wonder Woman, and you can't can't see all the trials and tribulations coming, and you just simply have to accept that. Here's a look at our results here on slide number 5. This is the roundtable scoreboard, and again, this is the relative return. So it's, again, benchmarking versus the Wilshire 5000 since inception, month by month. And as you can see over here on the far right, we actually have reached the point where we're smiling again. Those of you that follow me know that I smile more when this is the case. We actually are poked up above into positive relative returns. Now, Hugh and Ken have substantial positive relative returns, as do Nick Strategos and Herb Lemkool, our guest knights. And but the group average is what you're looking at here. And again, slightly positive. And again, that's actually pretty special. And as much as we say don't look at this until you've been doing this for a while, we are kind of approaching that period where we can start to pay a little bit more attention to it. And again, this is data through May 30th. You can see we had a bit of a slow start, but we certainly like this trend that you're seeing here left to right. The overall objective for the Modern Investment Club movement is this plus 5% that you see represented by this dotted line up here. Data through May 30th. And again, that 60 to 70%, we want to see our selections outperform. We're up to 51%. That might not seem good, but we were mired down in the 25 to 30% range for quite a while, so that 51% is actually kind of refreshing to us and certainly headed in the right direction. Any questions at this point, Ken, or should we press on?
Mark, the question box is clear, so let's keep moving, okay? Okay.
The next slide basically presents the 20 largest positions in the tracking portfolio. Again, anytime one of us, whether it's Ken, Cy, Hugh, myself, one of the guest contributors, or the audience, we take $1,000 and put it into that particular position. So what you're seeing here is the listing of the selections that have been made over the last, again, nearly 3 years, along with a little bit of a code down here at the bottom. As to, in the case of Walgreen and Staples that you see down here, they've both been selected 7 times, many times by Mr. McManus. So basically 7 times for each of those. $7,000 has been invested into Walgreens. You can see that's up to $11,000 here, and $7,000 into Staples. So that $14,000 invested into those 2 companies is now worth $19,000.
Mark, we are getting a hand in the air from Ed Brown from Grand Blanc, so I'm going to unmute Ed and let him ask your question, okay?
Hey, Ed.
Ed, you're unmuted. Go ahead. Well, Ed's also typing a question. He's trying a new mic and he can't hear anything. All right. Well, if Ed can't hear me, maybe Bob Medlin, who I see is in the audience, can give Ed a call and walk him through the audio switches. Bob and Ed are in the same investment club. Bob Medlin, maybe you could walk Ed through the settings button next to mic and speakers, and he needs to play with his settings button just a little bit.
Yeah,
but I'm going to remute Ed so that we don't get any feedback, and let you continue, Mark. Okay.
Well, keep plugging away at it, Ed. You'll find that there's troubleshooting stuff there, and you can get it figured out. It's definitely worth pursuing and having that capability. So again, just looking at this from top to bottom, you see quite a few community favorites. I even throw BioReference Labs into the community favorites. You can see it's been selected 5 times by us. So that $5,000 has turned into almost $8,000. So you basically see a whole bunch of pretty much community favorites from top to bottom here, with a couple exceptions. There's a few companies that have snuck into the mix that maybe not quite as well known on a national basis, like your Landauers, perhaps your Massimos. I thought I saw Massimo on there. Well, it's close to being on the list if it's not. But again, from top to bottom, pretty much a pretty consistent list, grouping of community favorites. And again, the key down at the bottom is the number of times they're selected. So you see the repeat selections down at the bottom. Do you guys have any comments or questions on any of these?
Mark, is there any way for us to
No,
get
not
a
for
rough...
me.
Mark, this is Ken. Is there any way we can get a rough idea of how well the individual holdings within Walgreen or Staples are doing in order to maybe look at some of these holdings for challenges in any way, shape, or form?
Yeah, we keep a running tab. We publish them from time to time, a running tab of every single, think of it as a transaction. All 7 transactions on Walgreen, we actually look at them and benchmark versus. I didn't prepare that for tonight, but if in the future when we are challenging a position, we can actually go back and look at that.
Okay, Mark, Ann would like to know, is this screen or a variant of this screen anywhere on the Manifest site?
Yeah, if you look on the home page at Manifest Investing, you can find a public dashboard or published dashboard in the right-hand sidebar, and I'll make a note to show everybody where that's at in the Q&A section.
Okay,
So
and Nancy would like to know, when was Hogs presented? I think they were cooking the books. And Nancy, you might be very well correct. Hogs was presented early on in the Roundtable's history, and I'm afraid I'm the culprit that brought it to the attention of the Roundtable in the first place. We haven't talked about Hogs in a long, long while. And I hear, if I'm not mistaken, that they're either being taken private or they're being acquired. Is that right, Mark?
That's correct. I believe at 13 and a half or something like that. So it actually got about a 40% boost a few months ago now. And I have not checked up if anybody knows the status of that transaction. I know that it's still traded as Hogs because it's still on the list.
And then I've cleared the question box for the moment, Mark, so we can continue.
Okay, Hugh, did you have a comment?
Want to show Ann where that reference is on the web page?
Yeah, we can go ahead and do that right now. We're going to have time tonight, so let me just jump. I'll come back here. And if you go to Manifest Investing, come in on the home page. Oh, it's actually not here.
Well, it is, Mark, if you click more.
It is, but I thought it was one of these listed. We'll change that. But
yeah.
It's down here under the More for Roundtable, and if you click on Roundtable, you actually get the full portfolio, including the smaller positions, top to bottom. And we are in the middle of fixing McGraw-Hill Financial. That's one of Kim Butcher's solid selections as a guest damsel. So it is there. And again, if you look at this link up here at the top, I'll highlight it. manifestinvesting.com/dashboards/public/round-table. And again, you can pull that up from anywhere. You can just use that link up at the top. And that is on display on the one at the site also. Okay. Let's go ahead.
Hugh, you were trying to get in there, Hugh. What were you going to say?
No, I was just going to comment on where to find it, but it turns out you're going to make it a sticky, I guess, on that list, Mark. So.
Yeah, we'll make sure it displays on the home page.
Yeah.
We're going through some iterations right now, so we'll just add that to the pile.
Let's try this sound thing again. This time Butch has his hand up, so Butch, you're unmuted. Go ahead.
Just a comment on Hogs. I do believe they have a company meeting on the 27th of June to vote on the question of the combination or a buyout, if you will, of Hogs at $13.50. So that meeting's scheduled for June 27th.
Okay, and it's probably trading pretty steady at that number right now, I would think.
I think it's $13.30 today or something like that.
Yeah, so that suggests that there's a high probability it'll go through. Okay, thanks, Butch.
It's interesting. Today there was an announcement. I can't remember the name of the company, but it's one of the largest pork producers in the U.S. owns many farms. It's going to be acquired by an investment group from China. if they get regulatory approval. And one of the comments that an analyst made was that this might help them with their quality in China. You know, if they have access to U.S. Methodology for making sure there's not contamination in the food supply.
And the entire audience, Hugh, is shouting at you that it's Smithfield Farms.
Yeah, that's right. I couldn't think of the name, but I've been telling people for years that within our lifetime, you better get ready to see Chinese investors acquire a company like Coca-Cola, McDonald's, or Disney.
Oh, my.
It's only a matter of time.
Oh, my.
And Mark, Ann is saying that that list of dashboards is only on your page, but Ann, that's not correct. It's on the home page of any Manifest Investing subscriber. Off to the right, that list is there, and you'll have to click, for the moment, you'll have to click on More, which is at the bottom of the list. That'll open up another list, and then you scroll down that and you'll find the roundtable holdings.
You can probably find it here also. Just checking.
And then I'm just going to thank in mass a huge number of people that supplied the name Smithfield for us so that I don't have to spend my next 20 minutes typing.
Excellent.
Here, okay?
Yeah, Smithfield is up, I believe, 30 or 40% yesterday.
Yeah.
Good stuff. All right, let's go ahead and get back. Again, we can repeat this, but let's go ahead and get back to where we're at. Ken, do you want to spend a couple minutes talking about the challengeable stocks and the overall portfolio?
I sure will, but first of all, Mark, I'd like to just explain on that dashboard that you had up for the roundtable. Susan says, am I correct in understanding that you have invested $4,000 in Teva and it's now valued at $27.27? And Susan, that's exactly the assumption that you need to make. Teva has not been a particularly good investment for the roundtable. We've invested 4 different times, and we have a net loss of about $1,300 right now. So that's just not a good investment, but you are interpreting the data correctly.
Yeah, that's actually going to come up a little bit later, and we'll take a look at some of the pressure that's been under historically also.
Let's move then to that slide, Mark, and I'll try to briefly go through what we're talking about here.
Okay.
This is the report card, if you will, and this is the first time in a long time for the roundtable that the report card has shown a couple of less than stellar marks on it, and we might have to do some adjusting in the portfolio in the next couple of months if we wish to keep our numbers in the zone that we've kind of set as our targets. My par, as of, and these are as of yesterday, I think, my par numbers, my par, which means the average potential annualized return for all of the stocks covered by Manifest Investing, and that's about 2,600 stocks. My par is just under 6% yesterday. That's historically on the low side that we've seen in the last, what, maybe 6, 7, 8 years even, right, Mark?
Sorry, I muted myself a little bit.
Yeah, that's on the low side, isn't it, of what we've seen in the last 7 or 8 years?
That's within an inch of a historical low.
Yeah. And we'd like to be investing anywhere from 5 to 10 points above that average value. That's the goal that we've set for ourselves. So in other words, we'd like the par value for our stocks as a portfolio now to be somewhere between 10.9 and 15.9. And for the first time in a long time, the par number in our portfolio is not green. We're 0.1% under the sweet spot, and that means that we might want to be taking a look at some of the stocks near the bottom of the list that are dragging us down. Our quality is superb. Our growth is also a little bit on the tepid side. We'd like to see growth, and we do say 10 to 12%, but we're definitely at the low end of the acceptable range. And frankly, I'd like to see growth at closer to 11.5% for the portfolio than where it is right now. PE ratio actually fairly average for the market. Financial strength, that's a really good number at 79. My investment clubs set targets of 80% for financial strength and earnings stability. So these two numbers, very close to that. I'm very satisfied with them. But I would like to be adding some stocks with a little bit more par, and I'd like to favor growth just a little bit more. I think if we're looking at the bottom of the list right here, we are seeing a couple of momentum stocks that are just making money much faster than we anticipated and might, in fact, be overvalued going forth, and that's the bottom two on the list. I happen to own Portfolio Recovery, and I'm loath right now to part with it because it just keeps chugging along and adding 1 or 2% every week or so. I consider Portfolio Recovery. I know a lot of you wouldn't consider a debt collector to be a core holding, but I've held this stock for years, and it's always treated me quite well, and it is a core holding in my portfolio. LKQ is the other one that seems to be on a momentum ride right now and just seems to be outperforming what the anticipated performance was going forward. And then notice we have a number of stocks at the bottom that are in very special situations. We've talked at length about Staples and about how it's in a turnaround situation, locked in a pretty fierce competitive battle with the other two office companies. Logitech experiencing all the issues that go with a declining desktop PC market. Strayer Education, we've talked about Strayer many, many times, and the related education stocks. I've likened it to standing in front of a freight train running right at you, and I would prefer just to step out of the way, but we did pick Strayer a couple of times. There's Hugh's choice of Bank America.
That we would be me.
Very, very atypical choice of buying a bank back in 2008, 2009, but I will confess that I listened very carefully when Hugh said he wanted to buy a bank, and I also bought a bank back at that time. I bought Wells Fargo, which I'm very happy with today, extremely happy with. SEIC Investments was one of my choices very, very early on, and it's done fairly well as a choice, and it might be something that we'd look to close out going forward, although it has an extremely high quality attached to it. So these stocks at the bottom are where we would look to sell if we were in fact looking to raise the par of our portfolio, and in fact that's what we are looking to try to do, is raise the par a little bit. We don't have a column showing growth, but in a similar fashion, we'd look for companies that are growing at a very slow rate and that have a relatively low par, maybe under the 5.9%, and we might consider them for getting for ejection from the portfolio as well if we wanted to raise the growth. Remember, all of these averages are based on the entire portfolio, and they're weighted so that Walgreens takes a bigger portion of these numbers than say something we've picked a single time like SEIC Investments, or I think we've only chosen Logitech maybe once as well.
Mm-hmm. You know, Logitech is the one that probably is the most damaged. I think an extremely important point that we should make here is the portfolio overall return forecast is low because a lot of stocks have gone up in price. They've gone up faster than the market. And you know, in Hugh's selections of Bank of America and Staples, although those return forecasts are relatively low, actually pretty close to the market average. Again, I'll put your words in your mouth, Hugh. Correct me if I'm wrong, but I think Hugh's expectations for return on equity for Bank of America returning to somewhat normal levels, and you know, profitability or net margins at Staples probably being a little higher than expected in the future. You know, again, looking longer term, and again, either one of those assumptions would yank those both up when it comes to the par or return forecast.
Yeah, if we were a little bit more advanced at this point and in dealing with this portfolio, if it was a more real kind of a portfolio, we might be considering various types of options or some other insurance, if you will, on these two really high momentum stocks that have just done quite well for the portfolio. I think Portfolio Recovery was the best performer at our anniversary, wasn't it, Mark?
That's correct, yeah.
And LKQ is certainly coming close to matching that kind of performance as well.
How many shares of Walgreen is in the portfolio now?
Let's go ahead and jump out and take a look and answer.
Because I was going to say, when
question.
you talk about options, I don't know if you're talking about a covered call. Again.
Yeah, so you've got Walgreen checking in at
yeah, so
225 shares.
200 shares. Yeah.
We have one of our audience members making the point about Portfolio Recovery that right now the company is benefiting from the debt that it bought during the lows of the Grand Recession when it was able to purchase debt at very, very few cents on the dollar. And the company is having a much more difficult time purchasing debt at those kind of discounts in today's market, so that Jane Johnson, one of our friends from Western Michigan, is projecting that its growth will not be nearly as quick as it has been in the last 6 to 12 months. And Jane, I agree with you 100%. At the same time, I still think that debt is surrounding us in all kinds of shapes and forms, and this company has proved to be quite profitable even when it buys debt in a regular market versus a market like it was buying back in 2008 and 9.
Yeah, and we'll come back and cover this in a little bit more detail when I talk about Apple here in a few minutes. But Portfolio Recovery, even though it's zooming, it's on a momentum high. It has considerable momentum, and we'll talk more about this later, but anytime a company has, basically it's overbought and it's running hard and fast, but it still has this huge block of momentum here. Again, if I'm holding it personally, I'm not in a hurry to sell it. I might be thinking, as Ken and Hugh were suggesting, covered call type things or maybe some type of limits or triggers, but I wouldn't be in a hurry. And just based on what I'm seeing there, we'll come back and talk more about that. Got a lot of momentum. So with that, I think I don't know. I think we're close enough that the transactions we make tonight will probably restore us back into the sweet spot. So we probably should go ahead and press on. What do you think?
Mark, we're getting a good question from Kurt Cormier, and I think maybe it's the basis of a lot of what we do in Manifest. So let me ask it, and why don't you try to give us an answer? Okay. He says both Portfolio Recovery and LKQ dominate their industries. What's the basis for the low par that's attached to these two stocks?
Well, the basis in the case of LKQ is quite simply taking a look at fairly rational expectations for how rapidly they can grow now that they are the absolute 1,200-pound gorilla in their industry, and they can only grow so much. And the price has gone up significantly. Again, it's just a matter of not ignoring. I'm going to pull up LKQ here on value line, and you can see that in the case of LKQ, let me bump that up a little bit so that we can see, value line, using the assumptions that they have for growth, profitability, and PE, also have a fairly low single-digit return forecast here. And again, we like to pay attention to the low return forecast. So it really is taking a look at the company. You really can't use the box down here. This annual rates box is completely screwed up by the acquisition, the major acquisition that they made, and you really have to take a look at a stock selection guide focusing in on just a couple years of history here. And when you do that, you'll see a growth rate somewhere in that I don't know, 8 or 10% range perhaps, along with margins that are expanding, but again, they're not going to expand forever, along with a PE that is probably going to live in the upper teens. You know, with those as the assumptions that we make, LKQ is probably a little bit overpriced. And again, LKQ, you're going to see the same picture that we saw for portfolio recovery. It's basically been overbought for a long time. And I mean, this is one heck of a run that the company has had. They're doing great things. It will come to an end someday. But again, a huge extended run of momentum here also on LKQ. And again, we'll cover that in a little bit more detail here in a few minutes.
And I think it bears repeating that nobody is suggesting that either of these two companies have anything wrong with them. It's just that the market's in love with both of them right now and is rewarding them with a higher PE than maybe is normal. That's what happens when a stock gets overbought, and I like to remind my investment clubs that sometimes the market hands you a pile of money, and if it's going to hand you a pile of money, sometimes it's prudent to take some or all of it and use it in something that has a higher potential at that particular moment.
Yeah, and we'll cover that in a little bit more detail again with Apple here in a minute. Let's go ahead. We're at about the half-hour point here. Let's go ahead and get into the selection part of the program. Ken is going ahead and bringing back FOSL, a company that's been quite good to us. It's on that top 20 holdings. So go ahead and take it away, Ken.
Well, I'm going to go to my computer here. If you just give me just one moment, okay. And I'll show my screen. And I'm going to start by going to the web page for this particular company. Has a picture of a really pretty girl on it and some other stuff. FOSL's a retailer. FOSL makes a lot of things, but I wasn't aware of how varied the things that FOSL makes. First of all, I like to look at the investor relations page, and many times for a retailer, when you search the page, you can't find investor relations, but I did find it way down here when you hover over About Us, and then if you'll notice, when you're at the About Us, you get investor relations popping up, and you can then read some various things about the company. But I was fascinated by the breadth of all of the holdings, all of the things that FOSL sells. I knew they sold watches and leather goods. I was not aware, however, at the scope of the different leather goods that they have. They have cases for tablets and cases for cell phones and shoes, and they're selling jewelry now. They're selling clothing, and not only do they have an extensive women's line, but they're also adding a pretty extensive men's line. And if you were to go up to here and hit men, you would also find a number of things that maybe you just didn't know that FOSL had. I like to come down here and look at summer must-haves. Probably not a must-have for a lot of our own demographic because it does tend to skew a little bit younger. But glasses, for example, there's a large presence in eyewear in this company. All kinds of watches, all kinds of clothing, and I just was not aware at all that the company sold clothing. So it's really branched out from its roots 5 or 6 years ago. We have a FOSL outlet store quite near us, and Natalie and I took a visit to the store a couple of weeks ago just to see how they were doing. I do own this particular stock, so I thought that I'd take and revisit its stock selection guide because some of the investment companies that I'm in right now, the investment clubs I mean, some of the clubs right now are looking at doing some things with Coach. We own Coach as well, and so I thought, well, we'll throw FOSL into the mix, and let me bring up my SSG. Oh, I hope I'm not getting a mess here. Well, I'm not going to be able to get my SSG up and going here. Let's see if I can do it that way. There we go. Okay. And I'm going to call in FOSL, F-O-S-L is the ticker. And I'm going to start with just a real quick down and dirty stock selection guide, although I've done quite a bit of research on the company and I'm quite content with the values that I'm going to choose. I noticed that the debt number is in a very pleasing place as far as I'm concerned. I like companies with no debt, but I can certainly look at a company with 10 or 11% debt, and they certainly had a pretty decent last quarter, sales growth and earnings growth moving pretty nicely. I like the lines. They're not completely, perfectly up straight and parallel. I do see the recession in here where they sacrificed a little bit in sales, kept earnings fairly flat, but the recovery certainly seems to be moving quite nicely for the company. I would characterize FOSL as a middle-class Coach or Michael Kors or Tiffany, something along those lines. Their price points are certainly lower than a lot of the other leather goods slash lifestyle companies, but they seem to still be aspirational, especially for younger folks. So I like that concept. I'm clicking here and I'm seeing that the analyst number, the ACE number, is at 18%, and frankly I'm comfortable with 15% growth rates. In fact, if you apply the preferred procedure to a 15% sales rate, you get about 15.5, 15.7 on the earnings rate if you adjust reasonably, and reasonable is in the eye of the beholder, but from my point of view, earnings are coming pretty close to following sales, and these lines are staying fairly parallel with each other. That suggests that the earnings should grow at approximately the same rate as sales. I turn this thing over. I have profit margins certainly moving, especially since the recession, moving in the right direction, moving upward. They seem to maybe have stabilized in the 17.5 to 19 cent range recently. A wonderful return on equity, and I'm looking at fairly decent and fairly clustered PE values. I might base my future PEs on the more recent PEs that are being suggested right here, and in fact my choices going forward were 24 and 11. Again, these aren't correct values. These are just values that I've chosen. Because it is a pretty high growth company, I've chosen to use the trailing 12 months when I'm setting my low price, and I do tend to choose that 4BA value many times if it appears to be reasonable. I'm checking it against the current price. It's much more than 20% less than the current price, so I'm comfortable with it. I'm not at all comfortable with the 36.5. I think it's way too low. The recent severe low might be a great choice for me as well. And I don't think I'd argue with somebody that wanted to boost that low price just a little bit, but it's in a comfortable place for me. Buy zone, 4 to 4 upside downside, and a return that comes fairly close to the manifest investing return. A return that I think is appropriate for a company this size. I'm going to turn this over. If I'm calling 14 or 15% growth, then I'm calling this a small company, even though based on sales, we might classify it as a medium-sized company. And when I'm looking at a smallish to mid-sized company, I'm certainly looking for something in the range of 15% or better. This SSG is suggesting to me somewhere between 14.5 and 22% return, and I'm extremely comfortable with that value. So all in all, my SSG for FOSL is suggesting that if I have the cash and if I have room for another consumer discretionary stock, that I might very well want to place more of this in the portfolios that I manage. I checked our consumer discretionary holdings for the entire roundtable portfolio, and they're not out of whack in any way, shape, or form. So I think this is a great second choice, or I guess it's the fourth time we will have chosen FOSL. So I'm going to put some more of that into the portfolio. I think it has room to run, and I like the concept of aspirational goods in a recovery, and I think the recovery has finally gotten to the psychological place where a lot of people actually believe that we're in a recovery. I think we've been in one for a couple of years, but I think just recently have people begun to believe that it's actually happening. So I'll leave you with FOSL for this evening. Mark?
Good stuff. Thanks, Ken. Yeah, we do have 16% of the roundtable tracking portfolio is in consumer discretionary, so that's certainly not out of bounds anywhere. I should go ahead and switch the presenter back to me, Ken.
It's coming at you right now.
And that's certainly an up, straight, and parallel. Like we said, this is a company that both Ken and I selected a few months ago, and the audience agreed. I do believe we're up at about a 20 percentage point relative return since we did that, so we're happy so far.
Well, we are getting a question from Ann, and she says, if you already own Coach, isn't it not kosher to also buy FOSL since they're in the same industry, basically competitors as far as portfolio of a club or of a person? And we're actually at the place right now where we're doing a little bit of a challenge against Coach. I own FOSL personally. I don't own Coach. I own Coach in some of the club portfolios that I participate in, and I would agree with you that probably holding both of those stocks in a relatively small portfolio is probably putting a little bit too much in one basket. But they don't necessarily, in my mind, compete with each other. I think they have a completely different clientele. FOSL skews to a younger demographic, and also to their goods are much, much less expensive than the things that you would find at Coach. So that's where I'm standing with it. And I don't like to burden myself with too many rules. So I'll spout them occasionally, but I don't have any problems breaking them whenever it makes sense to me to break them as well. So
yeah, and I would add that neither one of the two companies would be companies that we would fall in love with forever. And if the selling opportunity came on either one of them, I don't think any of us would have trouble unloading either one of them.
Absolutely. I don't regard either one of them. I have a hard time regarding any retailer as a core holding.
Mm-hmm.
I think that retail just has a lot of ebbs and flows to it, and you have to be willing to part with something even though you love what they're selling, and sometimes you have to be able to buy a retailer even when you hate what it's selling. I don't think you can go into the store and say I like the goods and make your decision to buy or to sell based on what happens to be on the mannequin at that moment.
Yeah, and I would agree with that. Back in December a few years ago, I actually made a case for many of the retailers, your Urban Outfitters, American Eagles, or whatever, being among the companies that have been the most rewarding to investors, and I know many of us shy away from them. So just something to keep in mind. Let's go ahead and
Len
switch.
Douglas likes to remind us that we should be calling all these things guidelines, not rules. And Norm says rule number 1, whatever makes the most money, buy it. So,
attaboy, Norm. Only when they go up, right?
Right.
All right, let's switch gears a little bit and talk about, again, Sai's not here, so I thought I would take the role of showing where ideas might come from. What you're looking at on your screen right now, I believe you can see that okay, right, Ken?
Yeah, it's great.
What I did is I went into the Value Line Investment Analyzer. It's basically the same type of thing you can do with the ValueLine.com stock screener. And you can basically just search for some of these things. And I've collected up some key characteristics. The most important one being here, the return forecast. Again, the projected 3 to 5 year. That's not the low total return forecast. It's something more along the lines of an average. But you can see it ranges from Apple at 33% down to Edwards Life Sciences at 21, and I stopped there. I have I do have 16 stocks there, and some fairly interesting names from top to bottom. As you know, our community and I have been very big on the information stocks, which would include companies like Apple, Infosys, and Cognizant. They're all showing up here at the top of the list, and they've all been kind of stuck in the mud here for a while, so maybe worth taking a look at. especially when we look at these financial strength ratings that you see over here. So these are among the stronger companies with fairly high growth rates, and definitely some companies worth looking at. But from top to bottom, again, with as we were talking a few minutes ago, the median return forecast at or near historical lows, I'm probably going to be a little bit less likely to pay attention to the Bs on this list. So I probably, if I'm screening, would set some of these aside. In fact, Synchronous Technology, a company that I think is a great study and one that I would typically bring tonight, I'm going to pass on it just simply because of this B plus for now. It's one that I've been trying to get warm up to for several months, and the darn thing's gone up 30 or 40% in the last few weeks. But maybe I'll just kind of step back from it a little bit and give some more thought to it. You see some more of the stocks. Here's from our damsels, Bank of New York Mellon. That one's been doing pretty well for us. Beardstown Ladies Bank down here, Hancock Holding, a good one if you want to look at some banks. Lo and behold, Hughes Staples is on here. And again, he's thinking very, very long term.
I noticed that.
Some good shopping opportunities here. But
so is AeroVironment, I'm surprised to see. That's a stock we just mentioned in the last 3 or 4 months.
Yeah, these are all pretty interesting, and I thought I would just, I'm going to go ahead in the spirit of today's market, and as Hugh's going to talk about here in a few minutes, we have trouble finding stocks that we can really warm up to. I'm going to kind of go back to home and go back to a stock that has not gone up with the market. In fact, it's gone down while the market went up here over the last year or so, and it's gone down quite a bit. Apple. And the fact that the price has stagnated and come back down into that $400 price range has driven that return up, despite the fact this is a very fundamentally sound company, sound financial strength, decent growth rate, although I'd trim a little bit off of that. I'd go with 14. But for the company that it is and the industry that it's in, the 70 on the earnings predictability is strong. And again, a PE ratio, it's hovering down around 10 right now. I think it's fully capable of being at least 12, if not 14, if not 16. And again, it's just a company that kind of calls out to me and says, maybe it's time to give it a go, especially as a long-term investor. So
Mark, could you explain again where this screen came from? Diane is asking exactly how you created this screen.
Yeah, the exact place that it came from is the Value Line Investment Analyzer. That's one of the tools and resources put out by Value Line, and it contains all of the regular investment survey standard edition stuff along with the expanded edition. But you can also do this if you're a Value Line subscriber or if you're at the library. If you go to valueline.com and then go to the left-hand sidebar and play with their stock screener that's in the left-hand sidebar, you can actually recreate this screen using that tool. I think you'll have fun doing it, and it's a pretty cool thing to do. I used to do a lot of this back when I was with Better Investing. So some interesting companies on there. I will put out this list as a separate post also so that you guys can take a closer look at some of these. And again, as always, this presentation will be posted in the Manifest forum, or you can write to any of us and request a copy of the presentation afterwards. Well, here's a look at Apple. Absolute blockbuster of a company. We all had the opportunity to meet Tim Cook up close and personal when he did his testimony in Inside the Beltway last week, so you got a chance to get a feel for the leadership of the company. I like him. I like their products. So the company just blowing the cover off of it, but again, they can't do that forever. As they get larger, just the law of big numbers means that they have to slow down. And again, when I think about this company, I am thinking about a company that can realistically grow in the 12 to 14% range. Anybody who says 20 to 30 doesn't understand what happens to big companies as they get big. It just simply has to slow down. It's still behaving like a relatively small company, but it will slow down, and that's what you're seeing here reflected in the stock selection guide. Again, keep in mind that we use analyst estimates for this year and the next year to form this picture. So again, with a traditional guide, your growth rate would be completely different. And I think this is a much more realistic picture of what to expect from the company. Still very, very strong. 14% growth rate is buttressed by a really cool profitability. We look at net margins at manifest, and we're looking at a number in the low 20s, 23 to 24%. To put that in your language, a little bit, if the effective tax rate is somewhere in the mid-20s, by the way, that's what Tim Cook was talking about on Capitol Hill, we're talking about a 30% pre-tax profit margin for your Section 2 numbers. And again, this is the area that's going to be under pressure from Samsung and the competitors. And the real question that you have to wrestle with as a long-term investor is, yeah, this has been a real massive, spectacular, and steady improvement over the years, but at what point do they kind of run into the wall or the speed bump? And I'm basically saying that they're pretty much going to have to be happy with something in those low 20s going forward. I don't see this company going to 30 or 40% net margins in the future, something closer to 20. And again, this is where the competition is going to manifest and really put pressure on the company and the return forecast going forward, something that you want to watch very closely as either an interested student or owner of the company.
Mark, Bilo said that several roundtables ago you commented about Apple conceivably being able to drop to $300. Do you still feel the same?
Yes. We're going to cover that in a minute. I wouldn't be the least bit surprised. I'm not saying this is going to happen. I wouldn't be the least bit surprised to see Apple go to 350 or 325 before it reaches 500. And we'll take a look at why I say that here in a minute. Okay, just a quick note for the third major judgment milestone, and that being the valuation of the PE ratio. You'll hear people, especially people who are addicted to or in love with Apple, complain about the PE ratio and think that it ought to be 20 or 30 because it's such a spectacular company. The fact of the matter is, it's getting bigger, it's going to slow down, and for that matter, it does behave like a small company, and it is somewhat erratic. It's almost cyclical. And if you put it in those terms, kind of the mental picture of a company that is a little bit more erratic, those type of companies typically have lower PE ratios. So again, when I think of Apple, I'm not the least bit surprised to see numbers like 12 down here. Wouldn't be the least bit surprised to see 12, 14. You can see Value Line's giving them a fairly robust 16 out in their 3 to 5 year forecast. But if I'm doing a study, I'm probably closer to that, again, 12, 14, 15 range as I do my work. Even with those type of assumptions, again, we're looking at a company, thanks to that price drop, and a very solid, fundamentally sound company in place. This lines up with those screening results. A very solid and attractive long-term return forecast, even if we might have to continue to experience a roller coaster from time to time. Looking at it a little bit closer
Mark,
again.
Mark, could you go back just to the Value Line sheet for one moment?
Mm-hmm.
Could we make the point for a couple of the folks in our audience that that 26% low return is based on a price of $460, and you can see it right at the top of the Value Line sheet in the middle, that the return and the price are tied to each other. So if the price changes dramatically, of course, the Value Line projections will also change then.
Absolutely, and thanks for bringing that up, Ken. Apple today was at 450, so it's actually it would be bumped up a little bit. By the way, anytime you see us publish Value Line return forecasts, and we use the low total return forecast, we correct every single one of those that we publish for, as Ken has mentioned here, the change in price, but then what Ken hasn't mentioned, the change in span, forecast duration. So we correct it for both of those things when we publish a number that you see us come out with in our weekly summaries. So we correct for both of those, and we correct for both of those continuously. Okay? Well, again, just reinforcing, 14% growth, 23% profitability, 15% or PE ratio of 14 or 15 leads you to a return forecast in the low 20s. Very high quality company. And when I look at this, first of all, excellence, it's excellence on parade, just basically banking up and hugging that 100 quality ranking over the years. And then we're also looking at a situation where the stock price has tumbled down into here. And again, with the fundamentals still relatively intact, we're looking at return forecasts that we haven't seen for quite some time. So it's looking as good as it has in quite some time. All right, I want to spend just a couple minutes. I don't want to get too carried away. I want to make sure that Hugh has plenty of time here for his section here. But what you're looking at here is a stockcharts.com presentation. If you're a subscriber at Stock Charts, you can look at 10 years. You can also look at it on a monthly basis. And I'm just going to bring this up to make a point that, again, we're looking at the stock price for 10 years on a monthly basis over time. You can see that there have been two fairly significant corrections in Apple. One is we're in the middle of right now, and the other one was back during the Great Recession back in 2008, 2009. And we're basically looking at two measures of momentum up here at the top, the Relative Strength Index, RSI. Anytime you get above 70, that's why the 70 is listed here. Anytime you get above 70, it's considered to be potentially overbought. And one of the things we know is that a company can stay overbought for a long time. In fact, this span for Apple is one of the longest spans we've seen for any company. It was basically not on sale or overbought for nearly 3 years. And again, you might have been skittish about that. We talked here last month about the work of Ned Davis and a momentum indicator that he looks at, rate of change over a 9-month period. And basically what you're seeing here is the rate of change over time. And what we would like to focus in on are these dips where all the momentum is gone. Anytime you get this in combination with these breaks in relative strength, I think you get a fairly nasty moment in time. So this nasty moment, again, back when we had these breaks here, a little bit of a nasty or a little bit of a speed bump here, but the fact that you had all this momentum, it was still okay. In this case, the momentum went away and the stock price got hammered. How much hammered? Well, it went from 200 something down to 60 or 70. That's a pretty good correction. And then in the most recent case, it went from, again, 700, and it actually did dip below 400 not so long ago. Now, just to kind of wrap up the thought, we talked about this a few months ago. Apple is for long-term investors. If you're a long-term investor and you're really committed to this, you can own this baby. But if you're not really committed, I mean, if you're going to lay there in a cold sweat, if you wake up tomorrow morning and Apple's at 375 and you're going to panic, this one's not for you, because that could very well be the case. Take a look at the situation back during the Great Recession. It went all the way from 200, 250-ish, all the way down to here. It actually came down and touched this is a 5-year trailing average. It actually got down as far as that. If history repeats, and I'm not saying that I know that it will, but if history repeats under the present conditions, we'd be looking at a stock price under 325 for Apple. That could happen. And if I'm investing in Apple as a long-term investor, I'm okay with that. Probably buy some more. But I would also not be surprised to see it languish a while like it did here. Again, if you're in a situation where it makes sense within your portfolio to take money off the table, this was a selling opportunity in late 2012. Some of you that have been hanging around with us know that in several of our portfolios we did sell Apple from those portfolios, or at least partial sales. Back in this moment in time, many of our subscribers also talk about using trailing stops, and they were stopped out at numbers like 650, 675, and they're happy to see Apple selling now for around 400. They're going to load up on it. So again, this is just, we're just basically suggesting that perhaps we can learn from history, perhaps we can better understand momentum, and especially when you're talking about a company like Apple that is literally in the claws or the clenches of the institutional traders, and they're the ones doing this, guys, and providing this opportunity. Notice that we have seen a little bit of a bottoming of the financial strength, or excuse me, the relative strength, perhaps heading back up, and we'll be hoping that the momentum does take a turn up to the north. But for now, I think it's worth making our 3rd annual purchase of Apple, and hoping for the best going forward, knowing full well that we could be required to demonstrate and live with a little patience for a while. So I'm going to add Apple to the tracking portfolio, third year in a row that we've done that in May. And with that, we'll turn things over to our unconventional and And this is definitely a first. It's unprecedented in the portfolio. Mr. McManus, take it away.
I warned you it was probably going to happen. I really couldn't find anything that I liked. And in fact, I haven't actually bought anything for about 5, maybe 6 weeks in a personal account. I told you, Mark, that I had a ShareBuilder account, and I got sick of them because they wouldn't give me the same deal they were going to give to new customers. So I said, okay, well, I'll become an old customer then. So I closed that account and moved it, and now I'm going to use it just to trade account, which I have, but I haven't really done much with to buy things. And last week, I mean, there were a lot of things that were cheap. AeroVironment, which I have bought recently in a personal account, but not here on the roundtable. Apple, of course, is cheap, but I want to get that price much lower. Caterpillar was the one that I acquired last week, and I had been adding that one steadily as well.
Last month.
As you know, I like to get things that are near 52-week low or even a 5-year low, depending on the company. And the third column, it says position, probably not the best of titles for a column, but if you look at Ameren Corporation, that's within 6.4%, 6.44% of its 52-week low. So you divvy up the range from high to low, it's quite near its 52-week low. And ideally, I like to get it when it's 20% or lower. It's very, very close to its 52-week low. I've been doing that for years. I'm just pretty religious about it, with some exceptions. Aflac is a hard one to get at a 52-week low because the price keeps increasing all the time. So I have to be a little bit less rigorous with Aflac. And for small companies,
most of us are happy with Aflac increasing.
Yeah. And so for companies like AeroVironment, small companies, I like it to be a 45-year low, and medium-sized companies, among which but Apple is maybe 2 to 3 year low, that kind of thing. And this week hasn't changed a lot. BioCryst is a company that took a bit of a nosedive. Abbott has changed recently, so I'm not adding anything more to that until I get a few more years data. But there's really nothing that I liked that was in the bottom part of the portfolio that I'd like to add. Direct is a company I talked about earlier. There's something I do in the pharmaceutical world, particularly the biotech, and that is when the company files a new drug application with the FDA to get approval to market a drug, there are various reasons that the FDA can turn it down. If the drug doesn't work or if there's safety concerns, that's one thing. But there is a reason the FDA sometimes turns down an application, and that is that there is a problem in what's called the CMC section of the new drug application, the NDA. The CMC section stands for Chemistry, Manufacturing, and Controls. And inevitably, 9 times out of 10 I've seen it, when there is a CMC problem, it is fixed within a year, and the application is resubmitted, and if the fix works, it gets accepted. And the fix works, as I said, 8 or 9 times out of 10. But the analysts and the people who buy the companies treat it as if it's a major catastrophe and the stock price plummets. So I often buy biotech companies if there is a problem in the CMC section that it files an NDA. Direct had a problem in the CMC section. It looks as if it's going to turn out to be the 1 in 10 chance where the CMC problem is quite real. But we will see. So I couldn't find anything that was nice and cheap this time, so skipped buying anything. And, this is just the same table, but on the right-hand side, the projected annual returns from Manifest are given as well. For those companies that are followed at Manifest, as you know, I have a tendency to buy companies that aren't looked at by many people, but I don't buy a lot of them. They're actually a small percent of the overall portfolio. But when it works out, they become a large percent of the overall portfolio before they get sold.
I would note, Hugh, that Apple's the most exciting of the ones on your slide.
Yes, but Apple's too expensive for me.
I know.
It's a 50. I'm putting Apple. It has to hit its 2-year low.
Hugh, could you repeat what CMC stands for?
Chemistry, Manufacturing, and Controls. CMC section. So, for example, I'm drawing a blank in the name of the company, but there are many examples in the last 2 or 3 years of companies that had CMC problems, sometimes not only once but twice, with their application. The FDA says no. The stock price gets whacked. They fix the problem, and it could be simple. It could be a paperwork problem. It could be that an analytical method, a process that you use to say, determine the purity of the compound. There could be a problem with it. The data that you might have collected, FDA may say, oh, you averaged something you shouldn't have averaged. It just could be what I think in court cases would be called getting off for technical reasons. In this case, you could get punished for technical reasons. More of a paperwork thing than anything else. So whenever there is a CMC section problem, I always jump on that. So that was that last week's, and this is this week's list of companies that are that I'm actually looking at and maybe add to the portfolio, but none of them is cheap enough where I'd like to jump on it and add it at this time. So that's why I gave it a pass. And as I said, I found a lot of companies that are both interesting and cheap. I'm borrowing a phrase here, but the trouble is that what's cheap isn't interesting and what's interesting isn't cheap. And so for that reason, I'm going to pass. And I do this. I mean, I'm kind of very insistent that companies be cheap. I know it's not a word that you like to hear about anything. I want it near its 52-week low, because I may not be good at a lot of things, but if I can get it near its 52-week low, it covers up a multitude of errors potentially. It can go lower, but most stocks are about half of stocks in the New York Stock Exchange. Half of companies will vacillate even 50 to 60% from high to low within a given year. So, moving on, wanted to just say a few words about Teva, and they're going to be very generic in general. Everyone's complaining about Teva right now, and I think there's probably a number of reasons for that. I see no fundamental problem with this company at all, but I do see in the generic space that a lot of things have been happening, and there's been a lot of merger activity. Generics, just by way of background for those that aren't familiar with the pharmaceutical industry, generics is a term that's used for drugs that are off patent, and it's generic in the sense that anyone can then manufacture the drug. The innovator firms like the Pfizers, the Bristol Myers Squibbs, and the Mercks of the world, they're the ones that do essentially all of the heavy lifting. They discover the drug, they develop it, they run the clinical trials, and after they've gone through many, many years of development, have successful results from often dozens of clinical trials, they submit an application to the FDA to get marketing approval. Now, in parallel to that activity, they would have filed a patent and a number of patents on the drug. And it turns out, usually the main patent that they file is on the molecule itself, plus an indication, and the indication being an illness. So you might have aspirin for a headache or general pain, as an example of how you would file a patent. But the patent lasts for 20 years, and a lot of that 20 years is gobbled up by the clinical trials that you have to do, the other developments to get the drug to market. So when a drug is actually approved by the FDA, there may only be 5, 6, up to 8 years left on the patent life. Sometimes they can get as much as 10. And there are ways that they can play to extend the patent, but you're never going to get the full 20 years. And once the patent expires, the FDA will accept applications, ANDAs, from any pharmaceutical company or really any entity to market the drug as a generic. You do not have to repeat the clinical trials. You can essentially use the data that the FDA has gotten from the innovator company as part of your filing, part of your justification for launching the drug. And generally, if the drug meets what's called, if it has the same bioavailability, so whatever the mode the drug is administered, whether it's an injectable or a tablet, if it essentially you get the same concentration of the active ingredient in the place where it should be, then you will have met a standard that the FDA would say is adequate for this drug to be marketed. The generics, despite what you will hear, aren't exactly the same. The bioavailability can vary by plus or minus 20%, but in almost all cases that's not a big deal. If it has a very narrow, what's called a therapeutic industry, like warfarin that's used for as a blood thinner, if you deviate very slightly by a few percent in the dose of a drug like that, it can cause problems. There's a lot more controls over drugs like that, but for most, plus or minus 20% is fine. And the FDA will give 6 months of exclusivity to the first company that files after it launches. And after that, it's open window on any company that wants to launch the drug. So you'll see maybe lots of people launching the generic equivalent of Lipitor right now Pfizer still owns the brand name Lipitor, but they no longer have a patent on the drug itself, on the molecule of interest. And they may extend the patent life by combining Lipitor with another drug, but they haven't done that yet, to the best of my knowledge. But in general, once it goes generic, that anyone can manufacture it, the price drops, and drops sometimes quite substantially. It drops because the pharmaceutical company can no longer sustain the high price that they had to sustain to try to recover the investment that they made on that drug, and in fact on the many other drugs that failed in the clinic or failed earlier. So it's one of the reasons that brand name pharmaceutical companies charge a lot more for the drugs than, say, generics, because the cost for a brand name company like a Pfizer producing the drug is significantly higher. Then the other thing that's happening in this industry, because there's a lot of pricing pressure globally, there's an expansion of opportunities in China and in BRIC countries, as they say, Brazil, India, China, the emerging economies. There's a lot of opportunities for generic companies. And so that has piqued the interest actually of large pharma. And so there has been actually reasonable...
Hugh, you're coming through loud and clear.
Okay.
Go ahead.
So there have been a lot of activities. King Pharmaceuticals, as many people know, was ultimately acquired by Pfizer. There have been other companies bought, Watson being a recent example, and many, many more. But Teva hasn't been part, I think, of that party. It hasn't been active in this area. No one has tried to acquire Teva that I'm aware of. And so I wonder to that extent, is this one of the factors that is, shall we say, that's made Teva not as frothy as some of the other companies in the market? For those of you who have followed Watson or who owned King, that stock price doubled and sometimes tripled in a short space of time. That hasn't happened with Teva. And I think it's because it's not part of this activity in the minds of many people. That's my speculation, at least. If we move on, you can look at what's positive and what's... So the stock price has languished, I guess, at the bottom line. It really hasn't done anything for some time. But there's nothing that I can find that is fundamentally necessarily bad about the company. I think it is well positioned for the future. It has strong cash flow. It is definitely a leader in its field. Its financials look good. It's not burdened by a lot of unnecessary debt. It has various activities, including some cephalon drugs that should generate extra revenue and ultimately, you would hope, push the price higher. And it should benefit from the global growth in demand for generic equivalents of brand name drugs. Every other generic company will benefit from that too, but I think Teva's in a better space financially. Now, it had an MS drug recently that is going off patent. It's 12% of the top line, so that is going to take a hit. And we saw this with, say, Pfizer a few years ago when it lost some of its big drugs, Lipitor being the biggie. That stock price languished for 2 or 3 years. It turned out to be an excellent buying opportunity for those who were patient and those who wanted to accumulate Pfizer, and particularly when it hacked its dividend after the merger with, I'm going to say American Cyanamid, but they changed their name. But it had two major mergers recently, and it hacked its dividend because it really couldn't pull all its cash that it had overseas to continue to sustain that dividend, so it cut it in half. But ultimately, the price recovered, and I suspect something like this will happen with Teva. For me, it's not near its 52-week low, but that's just one of my little quirks. And one of the downsides, of course, is that the pipeline of major pharma companies on which generic competitors depend, they wait for these drugs to go off patent and then launch an equivalent. That pipeline is skimpy. But again, everyone in the space is going to face that problem. So moving on, I see little that impacts Teva differentially, except for the loss of its leading MS drug. But the real game changer here could be how it deals with biosimilars. Now, when I talked about generics before, I'm actually talking mainly about what you would call small molecule drugs. These are drugs like the aspirins of the world, the Lipitors. They're not proteins or monoclonal antibodies. They are not biological drugs that are generally delivered via injection or something equivalent to thereof. These are your typical run-of-the-mill tablets that you will find over the counter or on prescription. Right now, there really is no clear way for generic competition in biosimilars, and that's to the advantage of companies like Amgen, which solely deal with, to a large extent, large molecule drugs, proteins and antibodies, things like that. That's going to change, and in fact the regulatory pathway is evolving quite rapidly, and Teva's in a very, very good position to take advantage of that. It has partnered up with some key companies in the space, a contract manufacturer called Lonza being one of them, and as the regulatory pathway becomes clearer, I would imagine that Teva will be in a better position than some of its competitors in this space. So you would see generic equivalents, say for the Amgen drugs and the old Genentech drugs on the marketplace available to consumers and presumably at a much lower price than the branded equivalents. And Teva's taking a leading position in this space. It's not newsworthy yet. It should be newsworthy soon. But I think it puts the company in good stead. So I'd say for those who invest in generics, I think the merger and acquisition activity has bypassed Teva for some time now, and those who put dollars in this space probably aren't interested in putting dollars in Teva. It's purely speculation on my part. But certainly it hasn't benefited from the expectation of an acquisition that some other companies that ultimately became acquired did, was their stock price just skyrocketed. It has a bolt-on strategy. It is buying other companies steadily, but I can't imagine Teva will be acquired. It could happen, but I don't think it will. The financials, the business strategy, to me look very, very good, and the company's also in a very interesting space for biosimilars. So I don't think there's anything fundamentally problematic with Teva. I just think it's taking a breather right now. And I would imagine that once there is more clarity in this space, and once the hysteria over buying generic companies has kind of quietened it a little bit, I would imagine that Teva will be back on a path to recovery of its stock price.
Hugh, Dan Hess is making a comment and asking a question at the same time. He says the new CEO seems to be looking for expansion in emerging markets, and an example would be the Procter & Gamble deal that it made to do some marketing with Procter & Gamble. Do you think that strategy is going to contribute to the growth?
Yeah, I think so. I mean, if you look at China particularly, but Brazil as well, these are economies that are doing extremely well. I think it definitely will contribute to the top line. This is virgin territory, if you will, for many pharmaceutical companies. There was simply very little of any business in both of those regions up until a few years ago. Aspirin, actually, which is a small molecule drug that's been around for well over 100 years, actually has done quite well in Brazil. It's launched there by Bayer, the innovator of that drug, discovered it in the late 1800s. But yeah, I think that you're definitely going to see an impact on the top line. I mean, there's going to be extraordinary pricing pressures there, and the low-cost supplier will be the one that wins. But you can see that people take health very, very seriously everywhere.
What I put on the screen, just for everybody's information, is I went and dug up some information at imshealth.com, the IMS Health company, research company. And just to give you a kind of a feel, if you look at this slide, and again, this is big picture. We're talking well above 35,000 feet. We're comparing global spend, and I know this slide gives everybody a headache, but just focus in on the yellow stuff. Back in 2011, you're basically looking at this slice of the global pie, basically jumping up to this slice up here, and then that represents, you know, a 10 to 12%. Again, very top line, and again with some of that international opportunity type stuff that Hugh was talking about. So again, a 10 to 12% ambient level, especially when you're talking internationally. If you go to IMS, I'll attach a copy of this in the forum, a copy of the report itself, but there's all kinds of stuff there, some fascinating slides on the aging of pipelines and all that kind of stuff. But again,
yeah, it's a good report.
As a resource, just take a look at it, and I learned a lot about how many drugs Americans take compared to the rest of the world. And it's staggering. But we are running up against our time limit. Ken, do we have a polling slide for the audience tonight? hopefully we didn't lose Ken to a thunderstorm or
No,
what
I'm here, Mark, but our polling slide is not working this evening.
Okay.
So we're going to have to forego the polling slide.
We'll let the audience off the hook for a month and let them celebrate their current position where they're at now.
Yes.
With that, we can probably take a couple of questions, but we are basically up against our time limit. So what do we see, Ken?
Well, we have some questions that we might be able to handle in our little bit of post roundtable session, but everything that's generic to our discussion this evening has been answered, Mark.
Okay. We'll take a look at the questions you guys have submitted in the questions tab and provide some answers in the forum also. Any other comments, Ken or Hugh?
No, not for me. I hope Sai's enjoying the game.
He's playing hooky.
Yeah.
I want to thank both of you for a great presentation again, and we'll see you folks next month at the roundtable. We have yet to set a date, but you'll be sure to get a communication from the Mid-Michigan chapter in the next couple of weeks to remind you about the date of the next roundtable. It will be somewhere near the end of June again, and I'm sure we'll have most of the nights sitting around the table again in a month from now. Thank you, guys. Appreciate it.